Thanks for tuning in. This is Chris Nichols with Twin Trades Capital. I'm going to show you today how you can open a short spread, a bullish short spread. So today what we're going to do, we're looking at a small account up $246. We started this year at 2,700. We're doing pretty good. Let's switch over to our big account. Today you can see we're doing pretty darn well. This is the spread I wanted to show you, Sayed Imam, if you're listening. Snowflake opened yesterday for a 300, 295 put spread that I collected. If you see right here where it says trade price, 256, and I opened two of those spreads. So my total potential capital return on that is $512. All right, and all it has to do is close above $300 on January 15th. What I like to do is open spreads that are at least 30 to 45 days till expiration. You can see here this one's 43 days. Okay. In one day, I'm up $182. And I'll show you why. It's because Snowflake has made a 15% move today. All right? So price was selling off. I saw that it was under 300. I said, hey, I'm bullish. So I'm going to open a 300, 295 spread, and I'm going to open two of them. All right? You could do a 300, 290 spread for the same risk and reward, but this gives me the option to close one if it makes a big move up. So right now I could close half of this position by buying back one of the spreads. So let me elaborate. If I were less bullish and didn't want to open a 300 spread, I could have opened a 280, 270 spread, or if I was really conservative, I could have opened a 270, 260 or a 260, 250. I can choose whatever strike is available to me. Only thing, the drawback is that you're going to get less premium the farther out of the money you go. So your reward to risk is going to go down as you get further away from the current strike price. Okay? So let me show you how that looks if I wanted to open a spread. So if I were Syed Imam and I said, hey, I think this puppy's going to go higher. First thing I'm going to do is I'm going to look not at the 15-day till expiration. I'm not going to get as much value, as much premium collected for that. I'm always, like I said, going to look 30 to 45 days out or more, but only up to about 60 days. And I don't want to do any weekly spreads because those don't trade on as much volume, so I have a harder time getting filled, and the bid-ask spread is going to be larger. So I would look to this January 15th, 2021 spread until that thing gets to about 25 to 30 days. I'm going to choose this one, right? Once it gets back down under 20 days, I'm going to look to probably the February, right? We have a monthly option contract that expires like, every 30 days or so. You can see between February and May, there's nothing at the moment. But as we get closer, as February rolls on, we're going to probably see some March and April contracts as well. Okay? So I would click the down arrow here and I would say, all right, this is what I do. This is what my process looks like. Okay, Syed? I look at the chart and I'll say, all right, I'm going to open a spread. What are the technical levels that I want to trade against? Well, here's one, that's pretty conservative, 285, all right, or 300. And I always use these technical levels. It's hard to look to value it or to see where the support is after a big move up, especially in something that just IPO'd in the middle of September. You could, if you wanted to, click on a smaller time frame and see what are there any support areas here. So I would say 280 looks pretty good. You wanted to zoom in, you could say 300 is a psychological level. 300 is an area where people will buy this now that it has made such a big move up. So let's say you wanted to just do the 300. So here's how you open the spread. Click on that option chain. You're going to go to the put side. And remember, you sell on the bid and you buy on the ask. So first thing I'm going to do is I'm going to look at, all right, if this is the strike I want, 300. See, I have all these open ones. So let's just use 280, 270. I'm going to click the bid first. You can see that it says P -1. That means I'm selling a put. And then if I wanted to buy a 270, you can see the difference there, 990 to 820. And sometimes it comes out a little different. I should look to collect 170 on this. All right. So that right there, I'm selling the 280 put, buying the 270 put. You can see that indicated by the -1 +1. I click next, and I can see I'm collecting 245 on this spread, okay? Usually on something that's 30 to 45 days out, I want my premium collected to be 1/3 or more of the width of the spread, okay? So I'll show you what that means. The width of the spread here between 280 and 270 is $10. I want my premium collected to be at least 1/3. So I'm usually looking to get about 300 to 400, sometimes even more, $300 to $400 collected when I sell options. It's not worth the risk to me to collect $245 because I'm putting up $755 of risk. You can see here, 755 is my max loss. That's if price goes below the bottom strike of 270. Okay. My break even, you can see, is 277. Every dollar under that, I'm going to lose $100. Okay. So that's why you can see at 270, my max loss is 755 because that would be $7.55 below 270, right? Or below my break even. So I'll show you an example. Snowflake just keeps ripping up, man. I'm probably up a little bit more now. Let's see what the total is on that right now. Friggin' thing is beast mode, 763 in one day. I mean, come on, man. I should be on Wall Street. 3,500 today, almost to 85 G's. Let's go. What's that return? 84,410. 84,410. Started with 48,000 this year. Divided by 48,000. We're looking at a 76% return. Come on, man. People on Wall Street don't even do that. I don't know if I'm gonna be able to get out of here now. Yeah, here we go. All right, so let's look at something else then. All right, let's look at, like, let's say Apple. Apple's got a good amount of trading history. It's a little flat today. We look at the chart, I can see that Apple, I got a lot of positions open on this too. I'm going to turn all my positions and drawings off because that's just kind of like clouding everything up. All right, so Apple right here, it's like right now it's in a like long-term pennant. You can see it shot up straight and then it's been bouncing around in a range between 105 and 125, right? So it's in a range right now. It's at the top of the range, but you can get a more clear picture on this if you look at like a weekly. You can see what I mean by like pennant, right? So you can see it went straight up and now it's been in a range. If I think Apple's gonna continue higher, and I think it is, the good company, right? What I would do is I could say, all right, I want to sell a short spread in Apple, and I think that 120 level, it's close, but I'll show you what I mean by that, right? If I look at the 120 Apple spread, 120, let's just say 120, 115. I mean, look at that open interest, 150,000 contracts open, man. Apple just trades like a beast. So you can see that open interest, a lot of people are banking, and you can see on both sides of the chain, the call side and the put side, 190,000 open contracts on the call side, 150,000 open contracts on the put side. So that 120 level, and then look at as you go up, you got 125, 130 calls. I mean, there's just a shit ton of volume here. A lot of activity today on the 145 calls. All right, 13,900. It's not too crazy, but it's a lot, right? So if I were bullish on Apple, I'd say, all right, I'm gonna sell a 120, and you can see the delta, right? The delta is 0.39. That roughly means that this has a 60% chance of expiring worthless. All right. As you go down, the delta represents less and less. So at a 10 delta, there's a 90% chance that the 105 strike is going to expire worthless, right? So you can see probability out of the money. That's showing you that based on the Black-Scholes model, which is the theory, option pricing theory that won a Nobel Peace Prize in like the 1940s, or maybe even earlier. This is how options prices are derived, okay? So if I were going strictly on statistics, I would always buy the 15 delta, because that's a 1 standard deviation move, and that's going to give me basically a 68 to 70% probability of profit if I always go with 1 standard deviation, okay? And that's just statistical theory, right? If I wanted to go 2 standard deviations out, I'd be at the 5 delta. That's going to give you a 95% chance of expiring of profit, right? But if I were to do that, like, I'm not collecting any money for that, man. Look at this. What am I going to do? Sell the 100 and buy the 95 and collect $16 and risk a 400 bucks? No, I don't think so. If you had a shit ton of money, we're buying 100 contracts, that makes sense. That's like what hedge funds do. But since I'm not a hedge fund, I'm okay with this. Probability of profit being, you know, about 56%. And, I would say that that's skewed because if you think about the sentiment in the market, people are bullish. We're heading into a new year. We're going to be closing out this year. Apple has been in a range. It's at the top of the range if I look at the technicals. So the skepticism in Apple is kind of going away. It's already put out earnings. There could be a sell-off known to like a binary event, an unplanned event, but I think right now Apple is a decent play, right? I probably myself wouldn't sell the 120. I'd probably look at the 115, but I'll show you the difference. So if I sell the 120 and I buy the 110, I'm going to get 278, which is close to 3, but it's not, right? So in my view, that's not that good of a premium. You want to know why? There's one other thing that comes into play when you look at selling options, and it's volatility. You can see the implied volatility is only 37%, and the IV percentile is 22, meaning that it's in the lower percentile of its volatility range for the year. So that means that options are cheap. Okay, when options are cheap, when the IV is low, under 50, and percentile is low, under 50, you actually want to be buying options. Okay, if the IV is high, IV percentile is high, it means that it's in the higher part of its range. So you'd want to sell that. So you can see that I'm really close to the money, only $2 away, and I wasn't even getting 300 bucks on a $10 spread. I'll show you the difference. Let's look at something that actually has high implied volatility. So I'm going to go to this watch list. I'm going to go for IV percentile, and I'm going to sort. I mean, IV is just really low right now, you know? Look at this. There's nothing that's over 40 because the volatility is kind of behind us. All right, and you can tell that if you look at VIX, which is VIX, a measurement of volatility. Volatility is actually traded on the CBOE. You can see CBOE Market Volatility Index. It's at 20. That's in the low range of where it's been. I mean, look where it's been just in the past month. It was up to 40. That's when we saw the sell-off. Volatility is high. Volatility right now is bouncing around extremely low, 20. It's in the low. I mean, look at it. If you go back out to the year, it's at the lowest part that it's been since the sell-off in March. So this is not a time to sell options, to be honest. This is when you want to be buying. But I will find one that has high volatility. Okay, you got these like small shitty companies. It's got 100 IV, but it's up 0.75. So it means it must have sold off recently. So let's just look at this. IV percentile 100. It's the highest reading it's had. It's got a weird chart. It had this huge gap up. It's bouncing around here. I would say if I wanted to, I would sell at 12.50, but I'm not going to collect anything on it. It's such a cheap stock. So what else do we got here that has a higher price and high volatility? That's what I want to sell. PDD, perfect. Chinese stock, high IV percentile. China has been beat down recently because of some of the stuff coming out about they're going to be delisted, but they have to just be compliant within the next 3 years. So I think that I'm actually bullish on PDD. I've been watching it. You can see it's in a range between 125 and 155, right? So if I wanted to, I'd probably look to the bottom of this range, the 128, 130 area, because that's also where the moving average is. So if anything, it would pull into here. So I'm going to go ahead and set my strike. Not even at 130, man. Maybe I'll do 130. I'll do a 130, 120. Or I could do a 125 if I really want to be conservative. A 125, 120. Let's see what a 125 gets me. See, this is higher implied volatility, right? You can see that. 71% is the IV. It's in the IV percentile is 65, so it's got higher volatility right now. So let's say I wanted to do 125, 115. You can see the spreads aren't that great, but they're not bad. 25-cent spread between the 125 strike. What kind of volumes here? What about here? People are buying the 155 call. All right. So this is going to get me 200 bucks, but I'm also $20 away, okay? If I were to do like what I did with Apple, where I was only like $2 away from the strike and it's a similar price, let's see, I wanted to sell the 140. If I wanted to sell the 140, 130, remember on Apple, I was getting like 290. See, 400 bucks. That's because of implied volatility. Volatility is factored into the price of the option, right? You have intrinsic value, extrinsic value, volatility. So on a similar spread, I'm actually $4 away. Same expiration, same spread, $10 spread. Instead of 290 on Apple, I'm looking at 410 on this. So I am more likely to do this one. But because of the fact that PDD is still in a little bit of a range, I don't know if it's going to break out or not. I don't know if I'm really happy with the 140. So I'm going to look at the 130, 120 and see if that makes sense for me. 130, 120. 282. So I'm $15 away for basically the same premium as I would be on Apple. I feel a little bit better about this. And the delta on Apple, it was like what, 55, or the probability of out of the money. On the 130, the probability out of the money is 63%. So I have better odds with this one, and I get about the same amount. If you remember, the OTM on Apple was like 55%. This is 63. So I have better odds on this of making money. So that's how your thought process kind of has to go, right? A couple other ones that I was looking at recently, Nvidia. I don't know what the IV is. It's probably not. Yeah, it's really low. But Nvidia, see, consolidating. It made a huge move up from March to mid-August, or what is this, September? Yeah, that's like early September when it started selling off. And it's been in a range since early September. It hasn't broken out of that 590. It's in like the middle of the range right now, right? If you look at like 460 to 490 is the bottom of the range. It's still trending above most of its two major moving averages, the 100 and 200. If it continues to move sideways, I could do something that's neutral. That's not going to get into that. I'm just trying to show you how to sell options. If I look at Amazon, that's another one that looks to be doing the same thing as Nvidia, right? And that's why NASDAQ has been not as strong, because these big tech names, which represents most of the NASDAQ, are in a range. You can see Amazon's between 2880 and 3500. It's a big range. It's kind of in the middle of that range. So there's another strategy called an iron condor. I'll show you that. So if I said, I think that price is going to stay between 3550, I'll just say 3500 and 2900, 3500 and 2900, I can put on I can put on a call spread and a put spread at the same time. Watch this. So if I say 2900, it's not going to go below 2900. Watch what we can do. Iron condor. It's not going to go below 2900. 2900, 2880. And I don't think it's going to go above 35. We'll do, unless the vaccine comes out, that's a risk, right? It's a risk to the upside. 35 to 35.20. I can collect 700 bucks, but I got a $20 spread. Is that 1/3 of the width of the spread? $20. 7 times 3 is 21. It's about a third of the width. So that would be a fair in my eyes. See, I'm risking 1300 to make 7, but I don't have to take the max loss. I can set my stop. See right now, 705. The way I make money is if this expires worthless. That means that I'm collecting right now $700, and I want this to go to zero. And that means I'll collect the full premium. It has to stay between my two short strikes, which are 3,500 and 2,900. If it stays between those two, I make the full boat. You can see it on the break evens. You got 28.92 and 35.07 are my break evens. All right. But I can, and the way that this would go against you is if the limit price right now that you're seeing 712 goes up. You're right. So if I wanted to say, all right, I'll collect 700, I want to do like 2-to-1 reward to risk. So if this thing hits 350 in losses, I want to close it out. So what I would do is I would open this trade, and then I would set I would set a stop limit, right, so that I would buy it back if the spread got to like $10 a share. If it got to $10, all right. If that limit price got to 10, that means that I selling it for 7, and I have to buy it back for 10. So I'd lose $300. All right. The max loss of 1,300 is the difference between the spread, which is $20, and the credit received, which is about 7. So 20 minus 7 is 13. That's why my max risk is 1,300, right? I would look, if I wanted to, I could say, this thing's bouncing around. I only want to get filled if it's at 720. I would just change it. Say, fill me at 720. Yeah, maybe I'll put this on. But with the COVID risk, I'd rather see I could just eliminate this call side. And I actually, I'm not gaining anything, to be honest. I'm not gaining anything from adding that call side. Did you see that? I got rid of the call, and it's not, and there's no difference. Or no, it's because I changed the price. That's it. It's probably going to be like three. Like, what's it going to be actually? Sometimes I have to go in and do this to make it right. So if I wanted to do that, I don't think Amazon's going to go below 2,900. I mean, that's extremely conservative. You can see that's got a that has a 80% chance of expiring worthless. 29 to 28.80. What am I going to collect on that? 360. So I'm only getting, I'm not getting as much. I want to be getting like 700. I'm only getting 360. Um, so that's it. I know that's a lot of information. Maybe I'll say it. Maybe I'll open a 3,000, 29.80. What can I get for that? 550. I think I'm good with that. Still lower than what I had said. So I'm not gonna fuck with Amazon right now. I'm just gonna stick to what I got. Plus, I think I got too much going right now. Boeing's up 400. Let's see where we're at now. Since we've been talking, up about 3,400. Okay. So that's it, Syed. I hope that helped, man. That's you know, in all seriousness, dude. Do you think people who are interested in learning options would pay to have a one-on-one session to walk them through this type of stuff? I think people would. I've seen that a lot. Where I've watched some YouTube videos about kids who are like telling you how to earn income and stuff, and this kid who was like an Amazon seller was like, "Yeah, I charge people $100 an hour to talk through how to make money on Amazon," you know. And he goes, "It's 100 an hour, but you can buy 15 minutes, so $25 for 15 minutes. I'll talk to you, and then whatever you want to do." So, and the reason why people do that is because he shows that he's made gains, right? So now I have finally made some gains this year in trading options and stocks. 70% return or whatever. Um, is nothing to balk at. So I'm thinking about how I can market myself as a brand and a business and try to make some money off of it. With digital ease of use, I can easily set up a screen share to show people how to trade, and I think that they would pay for that service. So let me know if you got any questions, man. Bye.